Should we give it another minute or get started? Go. All right, I'll start my timer. Try to keep us on track here. All right, hi everybody. My name's Brody Mulderig. I'm a banker at JP Morgan within our fintech practice in San Francisco. I'm here to present why banks are going to be rushing to embrace CTOs, product managers, and developers as an entirely new customer and partner over the next few years. So as part of this, I'm making an assumption that my audience isn't totally familiar with how banks operate, and I'll use this time to first convince you that you will be loved and bankers are rapidly going to embrace developers. And then I will open the proverbial kimono to show you how banks think about risk, where the roadblocks arise, and how to prepare for them. That part will be a little bit more interactive, so I'm happy to take questions throughout. So it should be no surprise to anybody that bankers spend all their time with finance staff, CEOs, CFOs, VPs of finance, and this has been the case and is still the case for most of the industry. Finance staff are the primary customer. All the products are designed to support them, and we'll refer to this current dynamic of banking relationships as a one-to-one relationship, and we'll come back to this concept later. But if you're a banker in the niches of tech or fintech, your experience is going to be quite different. You'll be working with a finance staff on a concept known as capital structure, which is a fancy banker term for saying lending. But you'll also be spending a lot of time with the CTOs and the developer staff. I've been covering the fintech industry my entire banking career, and I noticed early on when we were pitching our services to prospective customers that the CTOs would be present along with the team of developers, and then they would start drilling us with very technical questions around treasury management platforms. So we would get into these meetings because we had a relationship with the CFO or the business development team, but we ended up winning the deal and walking out of the meeting because we convinced the technical staff that our products were better. And so this pattern emerged early on, and that the developers were looking at the bank not so much as a bank, but as a tool to embed into their products. You fast forward a few years later, and the power of developers in the financial ecosystem's only been far more pronounced, and it's really transforming one of the most difficult industries to innovate in. So like I said, my experience working with developers is a pretty niche skill set within banking, but it's not going to be this way forever. And I'm going to walk through 3 reasons why I think banks are going to embrace you guys as primary customers. First, there's immediate economic incentives, which I'll walk through in the next few slides. Second, software is enabling verticalization in a way that's never been done before in finance. And so banks must cater to or partner with or buy these vertical platforms. And notice I didn't say build, and I'll kind of jump into why. And third is distribution. So the composability of all the building blocks of modern finance has enabled hyperscale distribution of financial products, and they have unmatched customer acquisition costs relative to the legacy industry. So let me go on through there. Oh, here's a disclaimer, of course. I'm not a lawyer, and I'm not giving you advice. So fintech VC funding is accelerating. I mean, it just keeps going up. When I was writing the business plan for this years ago, we were so excited that there was like $7 billion going into the industry, and now we're on pace to, if this year continues on, somewhere in the $80 to $100 billion range. But relative to private equity, corporate M&A, government research, the amount of money globally that goes into venture capital is actually quite small, but it still adds up to billions of dollars that are funneled into new technology, and venture capital and the portfolio companies they fund generate an outsized influence in the economy. And so in 2021, it's now estimated that 1 in every $5 of venture capital is going into fintech. So the sheer amount of money pouring into the space is going to create economic incentives in and of itself for banks to get involved. But bankers with a legacy mindset are going to look at this and say, that's a whole bunch of deposits that need like depositing. And that's not the economic incentives that I'm referring to. But of all the funding illustrated here, meaningful portions of it end up in new company formation, and that's generally a couple of technical co-founders. And that's where the first contact between the technical world and the banking stack come into play. So let's walk through some of the economic incentives. So these are fintech banks that are publicly traded, or that hold themselves out as fintech banks. It's not an exhaustive list, but I wanted to use public comps so we can illustrate the point. There's a bunch of private ones here, and so sorry if I don't mention any of you on this slide if you're sitting in the room. The first thing I want to point out here is that the banks are relatively small in terms of their asset sizes. This is widely talked about in fintech circles. Much of the incentive for small banks to participate in this ecosystem has to do with their ability to get much higher interchange rates on debit cards, and most of you here probably know that. But notice how much the stock has appreciated for this set of banks over the last year. It's the middle, I highlighted it in the middle there with the white border. 158% average return relative to 0.5% for community banks and about 10% for larger banks. So the shareholders are really rewarding these banks, but it shows the expectations are high. And if you look at asset growth, 13.3, it almost is double of what the large banks are getting, but if you notice Silvergate Bank, which is the bank where a lot of crypto companies go, their assets were markedly higher than the rest of the industry. So it's a bit skewed. So asset growth really isn't as pronounced as it looks in this average here, but the stock price has way outpaced the average. And then one last point to make is that the return on equity on the right, the 16.2 for the industry, is quite a bit higher than industry average, about 11% lately. And return on equity is a way that you measure profitability of a bank and its ability to contribute value to the shareholders. So that is pretty good and it's a little bit higher. But what you really see here is that investors have very high expectations for these banks, and the profitability and the asset growth has not come into play quite yet. So payments is this special animal in finance, and it's had this meteoric rise over the last decade. This one's the last 5 years, but over the last 5 years, you've seen it's completely outpaced everything else in the financial ecosystem. And generally, you don't compare banks to payments companies because they do have different financial models. But I think that they're intertwined in a way that they really need to be brought into where the future of banking is going. These indices that you see here are small community banks, indices benchmarked against the S&P 500, so you can see they've generally underperformed the S&P 500 over the last 5 years, but these fintech banks all of a sudden have really outstripped the market in terms of their stock price appreciation. And I think this has a lot to do with the way that it interacts with the payments. So payments tends to trade like software. And I'll tie this into my theory that I've gotten from being in the industry of why payments are so valuable from a development valuation standpoint later in the presentation. But it's a core reason that the banks are going to embrace developers and potentially get market returns like this that are atypical for the banking industry. All right, so let's take a step back from financial services and look at the broad macro tech trend. Developers building stuff for other developers. So none of us can predict the future, but if we use computer history as a heuristic or a guide for what may come to other industries in the future, you're going to see an upheaval of infrastructure, and then you're going to see the need to create new tools to interact with the new infrastructure. And the advent of cloud computing turbocharged software development, and along the way came vast fortunes for those who created tools to turbocharge the turbocharging in software development. So when you see these prices, you'll see why I'm a banker who likes to spend time with developers building stuff for other developers. And so speaking of developers building stuff for other developers, this is playing out in fintech. And so my extrapolation and projection of computer history into the world of finance is playing out nicely. So for those of you who have known me longer than this presentation, you'll have known that I've had the long-held view that infrastructure is the greatest threat and simultaneously the greatest opportunity for the incumbent banks. So I have to be clear, this is Brody's opinion. This is not necessarily the opinion of my firm, but this opinion has initially stemmed from going on site and doing anti-money laundering reviews on our clients. So depending on what kind of product you're developing, your bank may come and do an audit on site to look at your policies, procedures, systems, and whatnot before they onboard you. And so this is where I witnessed the vast improvements in the efficiency of onboarding, monitoring, and servicing clients. And so I can't accurately quantify that improvement. So what I'm saying now is a bit of a conjecture. But then it's led to this sort of also non-scientific thesis. But I would guess a simple act of having all the back-end systems talk to each other with modern software was like a 10x improvement for a customer service professional. And so, and this is for like normies that use graphical interfaces. I can't even quantify what it's like for all the superhumans that interact in command lines and compose APIs to build products. And so this developer building for developer trend is only growing, and it's being funded by VC funds with billions of dollars that are openly talking about how important this is. And you all saw Angela Strange yesterday. Michael Gilroy had been talking about it for a long time, penned an article in American Banker. Amias Garrity wrote a great piece on APIs I recommend that you read. But you have billions of dollars of dry powder and war chests within the VC funds to reinvent the financial infrastructure. All right. So a few minutes ago, I said I'd elaborate on the importance of payments. So the primary reason developers interact with banks on a technical level is to build on top of the payment schemes. Banks that figure out how to underwrite and onboard companies that generate lots of payments love the business. The payments generate nice margins. It helps with classification of good and bad deposits. Ask me about that later if you want to know what that means. But for a bank that is thinking beyond payments and lending, they'll view a fintech business as a high margin annuity. But due to a phenomenon now being referred at this conference as one-to-one to many, we'll see a transition from transaction monetization to API monetization. And so payments are a primitive financial function. They're mission critical and your product can't function without them. And if you don't have a bank to support you, you're in trouble. But as the infrastructure is broken down into its most primitive parts and the interactions with the money protocols are open sourced, the fact that you have a bank relationship will be less and less of a competitive advantage. Likewise, as more banks enter the space, I expect the cost of payments will go down, and because developers generally just treat them as a protocol to be integrated into their product, like HTTP or anything like that. So the future for banks in terms of business opportunity, risk management, and product development is in the data exhaust that comes from the payments that run through their platform. And I would argue that the banks have largely ceded the value of all this data to other market participants for a variety of reasons that make a lot of sense, but it's resulted in billions of dollars of market cap being sort of built on this second layer outside of the payment scheme. So here's just a simple example of somebody creating an invoice to buy some concrete and the data that can be emitted from this payment. So let's pretend Jill on the right here is a home developer and she needs to purchase concrete from Jack's cement company. So first, both parties need KYC and KYB conducted on them just to get bank accounts. That emits a lot of data collection. And this creates the context in the payment for who. Then Jill needs to schedule the delivery of the concrete, creating a work order in Jack's CRM. Jill wants to pay 30 days for delivery, so Jack needs to underwrite Jill, and he wanted to make the process smooth, so he leveraged tools like account aggregation to appear into her account to do the underwriting. But Jack needs the money now, so he finances the project from his bank, triggering more data to be used that's tied just to this one payment. And this creates trickiness for both Jack and Jill because they haven't actually exchanged money, so they need accounting software to keep track of what's going on. And Jill has taken upon herself to be environmentally conscious, and the cement industry is a huge worldwide polluter, so she wants to be able to offset the carbon footprint, and now it's tax season. And so to support this very simple transaction, every party in the chain has gone through similar problems and calculations for their own needs and requirements. So KYC, credit, accounting, taxes, environmental justice, it just keeps going. So the data to support this seemingly simple activity, it kind of explodes into like this fractal pattern of rippling through the financial ecosystem. And so I've kind of gone on long enough, you get the point. But what I've illustrated here is the data exhaust, the justification to collect data, the context of what goes on within a payment that's emitted from making a payment in a one-to-one relationship is immense. And so the point that I really wanted to make from it is that the payment is the force to trigger this activity. Otherwise, I haven't told you anything new. So I want to reframe the thought on all these ancillary services. Every one of these ancillary services was created to solve a problem that stemmed from making this payment. And as I said earlier, lots and lots of companies have created tremendous market cap supporting this. But almost every value-added service here was likely delivered by a third party. And again, the banks had ceded that to third parties to develop these tools, and that makes a ton of sense in a one-to-one relationship. But in the world we're moving into, in this one-to-one to many relationship, which I'll illustrate in a moment, much of this robust data, I think, will be a new revenue source for the banks. And it'll be used as a way to better manage risk and it'll be the basis for new product development for banks. But I'm going to take a quick detour into verticalization and tie this back together. So everyone here knows what Moore's Law is, and I don't know if Moore's Law is in its strictest definitions coming to finance, but it's costing far less to develop new financial products, and this is enabling tons of financial experiments by startups and even non-financial companies. And so now you can justify jumping into financial services because it's going to be, less of a headache, less of a cost. And so remember earlier I said 1/5 of all venture capital is now moving into fintech now, and it's going to go a lot farther than it used to. And so this is my second point as to why bankers are going to embrace the developers. All of this composability, coupled with the power of software to carve out extremely deep verticals, will change the way banks view themselves. So the endless experiments are going to make it really difficult for incumbents to serve all the niche communities that are out there, all the problems that could be had, all the identities, the industries, even the hobbies that could be tied into this. And that's all going to be carved up with software. And so this trend is already well upon us in credit card processing. It's a foregone conclusion. It's not really controversial. It's been in play for years. But the same force that carved up processing in a vertical SaaS here on the left is coming to every financial product: accounts payable, corporate credit cards, retail deposit accounts, business banking. And this isn't speculation. Like, bankers in my seat are seeing this roll out in real time, and every one of these other industries is starting to get carved up into vertical software. So by being an enabler to these services, a forward-thinking bank can inch closer to the dream of creating like the equivalent of an AWS in finance. So let's tie it all back together. So my three main arguments for why banks and developers should prepare for the big embrace and build upon one another. And if any of you know or follow Alex Rampell at Andreessen Horowitz, you may have heard him say that the battle between startups and incumbents comes down to whether the startup gets distribution before the incumbent gets innovation. In a world of one-to-one to many, look how extraordinarily fast distribution can occur. This completely changes the dynamic. So here's what all this infrastructure enables: hyperscale distribution of financial products through unique experiences that can't be replicated. And the tools of enablement are software and generate software-like returns and margins that banks historically have only enjoyed in the payment processing aspect. So if we look at how all this fits together, at the bottom of the stack is the bank. And the bank exposes a number of financial primitives, which is the purple Legos there. So you know that we lend, we manage liquidity, we do payments. Some banks are starting to get into KYC, but it's not historically something a bank has done or needed to do. Carbon offsets, you name it. Banks are going to deliver a lot of these services and expose them to the fintech ecosystem. But then if you look at any of these, and this is a simplistic diagram, but this is a real world example of the parties that are making these things work. It's well known that Stripe is embedded into Shopify, that they have a partnership with a firm. It's well known that Marqeta is deeply embedded into Square Cash, and that Drive Wealth is powering their investment platform. So you can just compose a new financial company like a set of Lego bricks, and a firm has 6 million customers, Shopify has 1 million merchants, who knows how many end users are buying off those platforms? I'm sure they do. Square Cash, as we heard yesterday, has 70 million users that can be targets of debit cards and investment accounts. So the distribution is really massive, you get the point. And so but what you see is non-financial companies like TikTok. If you've seen the Shopify partnership, they're embedding themselves into TikTok, so the billion users and creators and performers on there can accept payments right in the platform. So this is a really, really rapid scale distribution that's only going to increase. So what does all this have to do with roadblocks? It all ties back to the payment. Let's extend out of the banks. They're responsible for what goes on with the payments and the deposits. They're responsible to comply with the regulations. And so the risk looks totally different than a one-to-one relationship where the bank just deals with its client. In this one-to-one-to-many explosion out here, it's a completely different risk dynamic. So while I think that this is a huge opportunity for banks to benefit from the diffusion of labors that the developers create on their platforms, the tech and the regulatory environment aren't there yet. And I'm going to walk you through what it looks like in today's world on getting onboarded and what your bank is going to look for. And so this part can be a little bit more interactive if you'd like to chime in. Let me check my timer. It was just about 20 minutes, so we have 20 minutes to sort of walk through the risks. All right. So some of the main risks that they're going to consider is credit. So there are credit risks that are embedded into the payment schemes. Most of this can be focused on payments because lending's a different animal, and if you're with an early stage company, it's going to be kind of hard to get underwritten. But there are credit risks that go on within the payment schemes. Reputation risks. Banks they just want to work with clients. They don't want their names dragged into the headlines. And so if their clients are abusing customers or having data breaches or whatever, you get big enough, and that might, pull the bank's name into the press. And then regulatory. The fines are huge for failure to comply. They may penalize banks for supporting seedy companies. Anti-money laundering is particularly pronounced. This is where fines are in the billions of dollars and criminal charges are possible. And then regulations vary, and there's 50 state regulation in the United States. So this is what all the things when a fintech approaches a bank that the bank's got to think of. Are they doing this? So compliance and regulatory risks. This is just what I pulled from fintech companies that are publicly traded. This is in their annual reports, regulations that they cite that they have to comply with. So this is not an exhaustive list. And none of you can probably read all these regulations, right? The text is too small. And that's the point. That's the punchline of the slide. You're going to and they have all this stuff they have to comply with, and you're expected to comply with this. And so it gets pretty arduous for fear of what could go wrong, any one of these regulations being triggered. And it would be really nice if there was a conference somewhere with a bunch of developers building APIs that could maybe deal with this. And so if any of you hear of something like that, let me know. So here's sort of the fundamental problem. The bank has limited insight into your customer. So your bank's here on the left. You're the green company in the middle there, and they're looking at you. But then you have your own customer. And so the bank can't really see into that customer. They do have some info. So like their information is going to run through the payment schemes. But they can't see necessarily what had been done on a KYC standpoint. They can't necessarily see if that's a synthetic identity. They can't see if they're laundering money on your platform and a whole bunch of other platforms in the current environment. So in order to deal with this risk and this dynamic of being unable to see to the end customer, and if you think of the Lego brick slide a couple slides back, fintech's building for fintech, right? And so you get even more layers going through here. This is very manual, very paper-based, very thorough. Your bank will probably come out, do an on-site review. You're gonna need a compliance program. You'll probably need legal opinions from legal counsel as to why your business is not violating a whole bunch of laws or that it's getting appropriate licenses. And there's zero tolerance for the AML. I can't emphasize that enough. Like that will torpedo your ability to get onboarded directly into a bank. It's very high stakes in that realm for the banks. So let's walk through, any questions there? Feel free to chime in, and I'm going to jump into the payments infrastructure. All right, so ACH. So, I mean, really the genesis of this conference came around open sourcing, some of the ways to interact with the ACH schemes. This is a system that was built in the 70s. It runs on a batch, which is what we would call net settlement. And it's super cheap. That's the benefit of it. It's really cheap. You're going to use it a lot. You use it for recurring payments. It is used extensively, but it doesn't really have a lot of, unlike the card networks that are really expensive and sort of built this ecosystem around them, there historically hasn't been a ton of insight. You really went in blind when you debit your customer's account. So this system has a big degree of operating risk that can be really painful for you as a fintech company. So let me walk through really where this stems from. But the Nacho rulebook, if anybody's read this, it's like 500 or 600 pages that you have to interpret. And what it gives is the sending bank. So this is your bank, referred to as an ODFI, originating depository financial institution. They're going to receive a payment instruction from you. They have 24 hours to submit that to the clearinghouse. They're going to forward that on to the RDFI, receiving depository financial institution, which will then be posted to your customer's account. They have 48 hours to accept or reject that payment. And so what this creates is about a 72-hour window. And this is in the rule book, so this is what it's underwritten to. Most of the time this happens faster in today's world, but it's still what your bank is going to underwrite for. You have 72 hours where the payments can fail. So this is going to be insufficient funds. This will be wrong account number, what have you. So you're going to get credited an amount, and then some of that amount may disappear. And that's, if you can't return those funds to your customer, your bank is obligated to do it, and that's where the financial loss can come in. So the way that they mitigate this, particularly for young companies who have no revenue, no product, burning cash if they do have products, is to set aside a bunch of collateral. So they're gonna mitigate this risk by asking you to take this really, really expensive venture capital money you just raised and put it into a certificate of deposit earning nothing to mitigate this risk. So this is something you're gonna wanna plan for in the way that you, when you fundraise. And as your exposure grows up because you explode, like that, your bank may come back to you and ask for collateral. So the benefit of going directly to the bank is you're generally going to get your funds faster. When you see fintechs doing this for other fintechs, and it takes 4 or 5 days for an ACH to go through, this is why. Is because they don't want to ask you for collateral and tie up your collateral, so they're delaying the availability of the funds. So I see some heads nodding, like, oh, it makes sense now. And so, so those are the trade-offs. You may have delayed availability, you may have to post some collateral, or you may just have somebody who's willing to take a ton of risk on you. But that's the dynamic that you're going to deal with on ACH. And then there's this quirk for consumer payments. And again, this is where like the open source community I think is going to be really cool and how it interacts with the payment schemes, because everybody's interpreting these these payment scheme rule books in different ways. There's debate whether it's 60 days or whether it's 90 days that a consumer can charge back an ACH transaction out of their account. The language says 60 days from the date of the statement, right? So it's like even the banks and the people that underwrite it can't agree necessarily on how long they're exposed. So consumers get a little bit heightened sensitivity from a risk standpoint because they may dispute that. If you're familiar with this, is the R10 code that will return back to you and tell you that the payment had failed. And the way that this is managed is pretty varied in my experience. I've literally had clients that have had a dispute from, say, a regional bank or another large bank, and they get notified in the mail that there's a dispute, and that they want them to fax proof that they got authorization to do the debit in the first place back to the bank in order to settle the dispute. And so there's like this interesting infrastructure that does not appear to really exist in the way that this is managed in the ecosystem. So I've seen mail, I've seen fax, I've seen emails. And so this is just one of these things that you just have to deal with in the ecosystem, and maybe there's some tools that people can develop. There's been a lot of focus on ACH over the past few years because it's such a critical component. Anybody have any questions on this? I see a hand back there.
How is the fee split up? So like you charge 8 cents for the ACH transaction. Are they all these players? Who's getting what out of that 8 cents?
Oh, okay. So ACH doesn't have like an interchange style. I actually have a diagram to walk through card interchange later on. But it's generally, for a next day ACH, it's generally the originating bank that has a relationship with you that's charging the fee. You can mark it up if you'd like, but that's generally who's getting charged. There are some small fees that run through the network. These are on like I think you can find this on the Federal Reserve site. They're really minuscule. The clearinghouses, the operators charge, but they're fractions of a penny. In same day ACH, the receiving bank gets paid 5.2 cents. So this is why same day ACH costs a lot more, is there's an embedded 5.2 cents into the network. And I guess the incentive is almost, I don't know if you'd call it interchange, but it's kind of in the same way that interchange came into play in cards, is it's trying to encourage smaller banks to update their systems to process things faster. So they get paid 5.2 cents. The receiver in today's world, I mean, I don't know of any examples where the receiving party is getting charged a fee to receive an ACH. So I know that was kind of long-winded, but basically your originating bank is going to charge you what you agree to with them, and then you can mark it up if you'd like, give it away for free if you'd like, but there's really not this really complex fee scheme like you see in cards.
So a wire transfer is not an ACH, that's different.
Yeah, I do. I'll go to wire transfer next, but yeah, it is different. Any more questions on ACH? All right, so let's go into the card networks. And so we see this a lot, and there's been a big explosion in innovation. But think of the cards as there's like a two-sided network. You have the card issuer, and then you have the card acquirer. And fintech has historically played in the card acquiring space, and that's been carved up into vertical SaaS. I mean, I don't know if I really need to go through all the use cases, because I'm sure you have used a card and know what it's used for. But your bank, if you're getting a merchant account, right? So if you're going to Stripe or you're going directly to your bank because you want to accept credit cards, you're going to be underwritten for a number of things. One's your financial profile. The other one is the big one that comes into play is future delivery risk. So this is where it gets difficult for travel industry to get credit card processing. Like there's a few niche players that do it, but the travel industry books something, they pay for it now, but the product isn't delivered until some point in the future, and there's a risk of chargeback because of that. But if you're delivering something like a sandwich, you may have fraud in that scenario, but there's no risk that it's not going to be delivered in the future. So that can come into play, and one thing that you'll want to think about, like if anybody here is developing, say, like warranty services or something like that that's going to be delivered at some point in the future, you'll want to prepare for that. Cardholders tend to have a long dispute window, but there's a lot of infrastructure around chargeback management. So unlike ACH, where it's kind of cobbled together and the industry treats it all very differently, there's a lot more tools in the card networks. These are pull systems. Oh, I forgot to mention in ACH, it's a pull and push system, which makes it unique. The pull piece, which is where you're pulling funds out of your customer's account, that's where the risk comes into play, the credit risk that I talked to. If you want to push funds out, there's generally not credit risk. It's pre-funded. Card networks likewise pull, but the benefit you get out of the card network is if it's authorized at the terminal, the funds are guaranteed to show up. You don't have that benefit in ACH. So the funds will show up on a debit card or a credit card. Doesn't mean they won't get disputed later, but they will show up. Any questions on this? Go ahead.
It seems like physical cards are going away very slowly.
Mm-hmm.
They don't even have cards in like Iceland and Estonia.
Yeah.
If the physical cards go away, will that change this at all?
I don't know if it's going to change the way the networks operate. It may change some of the fee structure that goes into the network. So most of the fintech companies you're familiar with just kind of give you one rate, 2.9 and 30 cents or something like that. But there's a whole mess of complexity underneath that in terms of what the actual costs are. Back in the day, they used to break these out by various tiers and whatnot. And so you would have like a card present is generally considered lower risk than like an internet transaction, right? And so with the tokenization that's going on in cards, you may be able to benefit from online transactions and get lower card processing fees because of the technology makes it a little bit more secure off of a phone or like Apple Pay on a laptop. So I don't know if it really changes the underlying infrastructure though, but it may change the fee, the way the fees operate. And then one thing, you're probably aware of this, but there's a term that's used in payments, ad valorem. So ACH is like a per transaction fee, and depending on your volume, it can be 10, 15 cents, but it may go down to less than a penny, and you're just going to pay per transaction regardless of the transaction size. In cards, it's an ad valorem, which means it's a percentage of the transaction. And that's a large part of why this is a bit easier to monetize historically. So like I said, this side, the merchant acquiring side, that has historically, that's PayPal, that's Stripe, that's what Square started as. That's historically where a lot of the innovation had been, and now we're seeing the explosion over here on the card issuance side. Debit cards is the main one, but we're going to start seeing credit card as a service. That will come down. There's a big push through single-use accounts. And let me walk through how the economics of that works. This is generalization, but there's a lot of parties, to your question in the back there's a lot of parties that get involved in making cards work. And so why does it cost 2.9% and 30 cents to process a transaction? Well, one is it doesn't. You can get it for much cheaper than that. But generally, the providers that charge that are pretty convenient and easy to get set up with. So you have the card brands that maintain the networks. They tend to take a really low fee of each transaction, and their fees are disclosed. You can go do research and see exactly what they are. But those are the four big card brands in the United States, and there's others in other parts of the world. The issuing bank, this is what was interesting, and nobody talked about this until the explosion of Chime, frankly, in the ecosystem, is that the issuing bank took the vast majority of this 2.9% pool of fees. And so that's what fintech right now is really is exploiting and monetizing, is reinventing this deposit and card experience, because that's where the biggest source of the fee is. The sponsor banks and the processors, those just sit on the back end. They provide the switching technology to make all this work. They tend to have the lowest margin of the whole pie. Haven't seen a lot of innovation there, probably because it's super difficult from an infrastructure standpoint and a compliance standpoint, and there's not a lot of upside there. And then the processor here, this is where Stripe and PayPal and all those would make their margin. I just realized I made a mistake on the math here, but you take $100 and then the fee that ultimately goes to the merchant in this case should be, excuse me, it should be somewhere, around, $96, $97. This is what they would negotiate, and this 2.9% could be actually quite a bit lower. You could get, I think Square is now at 2.6%, and it can be much lower based on, a number of factors in the market. I'm assuming most of you are from smaller companies. Generally, you don't have a lot of control over much of the cost structure in here other than the processor margin if you are going to negotiate with your processor to process cards on your behalf or become one. If you're really large, like Walmart and Amazon, they're going to have negotiations through this whole stack, and they get better rates than everybody else does. Any questions there?
The sponsor bank is really the merchant side bank, right? Or is the sponsor bank the merchant
Yes.
side bank, basically?
Exactly. You have an issuing bank and a sponsor bank. So if you're a merchant acquirer, you have to have a bank sponsor you. And these are some of the banks that are pretty prolific in there. But yeah, the issuing bank is going to be their brand is going to be on the card itself or on the back of the card. So one thing you'll notice with a lot of these fintech neobanks is if you flip the card over, you'll see who issued the card. So it's pretty easy to figure out who's playing in the space. They'll look very similar. Well, assuming it runs through the credit rails, which is what the fintechs want, because that's how you get the robust interchange. It's going to look the same. The fees are generally going to be different, because the fee for a debit card and the monetization comes from this piece here. And so the reason big banks don't play in that space is because the Congress, as part of the Dodd-Frank legislation, has this thing called the Durbin Amendment. If your asset cap is above $10 billion, you get dramatically less economics in there. So this is all small banks issuing there. So debit cards, I don't know the exact, it's all public, you can go look it up. I don't know the exact dollar amount, but like a debit card with a non-exempt card versus an exempt card have fees disclosed, and that's where this comes from, but it doesn't change the infrastructure or the fee structure throughout this. Did that answer your question? Yes. Well, kind of. When you do, when you get this bundled 2.9% and 30 cents, or 2.6 and 30, or whatever your processor's charging you, they don't delineate between a debit card and a credit card in that structure. So some of the credit cards, like a corporate card, are very expensive to process, and so they raise their price above that threshold. But they would love when you use a debit card because they get a lot more margin as the processor. So if you're using debit cards, these platforms typically really like that. If you're using credit cards, the issuer likes that. So there's a bit of a tension in there.
Why is that?
Because if you're issuing a credit card, the interchange is much higher. It's risk, yeah. I mean, that's what the card networks are going to say is that it's risk. So all those rewards you get on your credit card, the merchants are paying for that. So when you're getting 2% cash back, it's because the interchange in there somewhere might be like 2.4% or something going back to the issuing bank. So credit's just generally seen as a higher risk product than debit, hence higher interchange. Corporate cards are, for some reason, I mean, I couldn't explain, maybe somebody has insight into this, but corporate cards are generally the highest tier. International cards, that one's kind of obvious because an international transaction would usually be much riskier than a domestic transaction, but those are where the interchange rates climb quite a bit. And for some reason, prepaid debit has higher interchange. I don't know why that is, but we're seeing, you see actual debit card issuance tied to a deposit account in fintech, and you see like an omnibus account that issues prepaid debit cards. So, the ecosystem is really trying to find ways to sort of hack the fee structure of the card networks in order to monetize. But it all looks the same to the end user. Anything else here? All right, we got a question about wires earlier. Basically, wires are used for high dollar payments. This is a real-time gross settlement, so it's going to settle faster than an ACH payment. That's the advantage, but it costs a lot more. And the structure of how it works is very similar to how ACH works, except it's just not necessarily run on a batch-based system. You do use wires to do cross-border transfers. One interesting point of trivia, which I haven't built out a slide for this, is money actually never crosses borders. It's done through correspondent relationships, but it's leveraged through the wire system. You wouldn't want to use this for consumer payments. A lot of consumers, when they get a wire, may get charged a fee by their bank, whereas you don't get that for ACH. But the benefit is it's faster settlement. You can send big dollar amounts through it. The problem is once it's gone, it's gone. And a big trend we see in banking is something called imposter fraud. Essentially, hackers take over their email systems of a company, and then they pretend to be like the CFO. Hey, we're going to make an acquisition somewhere, in some far-flung country, send a wire there, don't tell anybody about it, it's super secret, and then the hackers run away with the funds. So that's the downside of the wires. No credit risk, though. So this is the last one I want to highlight on. I'll go through this. This is where we have a ton of developer interest. This is a new payment scheme. So this is the real-time payment scheme. It's developed to be API first, so developers like that. You connect via API. It is a real-time gross settlement, like the wire system. It doesn't have credit risk, so it's a good funds model, so you don't deal with the problems you deal with ACH. And the payments show up in 15 seconds or so to your end customer. It's rapidly gaining adoption. It doesn't have full coverage in the banking industry yet. But it's all push payments. So if you want to push funds back to your customer account and do it in real time, this is RTP. And we see a lot of monetization with fintechs doing this. So RTP costs more than ACH, but fintechs are marking that up. So hey, you want an instant payment, pay us 1% or whatever you want to charge. We see a lot of that in the space. There's a new product that's just rolling out now called RFP. This is a real-time payment scheme, but this allows you to quote unquote pull funds. It's actually done through a push, so there's no credit risk, but you can request, RFP stands for request for payment, so you can go to your customer and request that they fund the account. And the benefit of that is you take no credit risk, you can get them access to their funds immediately. So this is just kind of what I wanted to highlight is the user experience is a little bit different here. It's different than the ACH experience, so you'll want to probably be aware of this if you want to use this and start thinking about how you're going to develop the experience. And we see a ton of interest from investment platforms that want to use this because they have this problem of not having funds available for immediate investment and then also the risk that comes with funds not being available. So say you're a trading platform, you want to have your customer fund the account. They would go into a user experience like this, hey, I want to put $3,000 in it. They're going to confirm that transfer amount, but it takes them out of your app to a text message. They click that, go through their bank, approve that payment, and then the payment is pushed for immediate use into your app. So there's a lot of interest in this. We actually have one of our product managers here I can introduce you to if any of you want to come up to me after, but there's the real-time payments network is where we have there's a lot of interest in the ecosystem on that one. So how are we doing on time? We have 1-2 minutes. Any questions, and then we'll wrap up? Is it Nacha based? No, it's the clearinghouse. Well, I guess clearinghouse is involved in Nacha. It's governed by the clearinghouse rules, I believe. It's not Nacha. For the operator in the center, it's the clearinghouse. Yeah, it's like a consortium owned by banks. They rely on the Visa, MasterCard, and all the infrastructure that I walked through here. What they do, which is interesting, is they say, hey, bank, you want to issue your card, because every bank wants to be top of wallet. That's a term you'll hear in banking. They want their card to be the primary used card. Well, hey, our phones are in people's hands like all day, and this is a great, way to be top of wallet. If you want your card in our wallet, then you need to pay us a portion of the interchange. So I think they're getting something like 15 basis points. You'd have to check me on that. Maybe somebody knows the actual number, but of that big pool of interchange that the issuing bank's getting, they're giving a portion of it back to Apple and Google. Anything else? Great. Well, come up and ask any questions throughout the conference. If you want to talk to our RTP developer, let me know. But I appreciate you coming.